This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long. It's my pleasure to have with me this morning Charles Hugh Smith, well-known and prolific writer on the web, who is the publisher of the well-followed website of2minds.com and longtime co-host with me here at Macro Analytics. Welcome, Charles.
Thank you, Gordon. Always a pleasure.
You know, what I always marvel is just how quickly the month goes. It just seems like we finished one and we're doing another one. But I always look forward to them because we actually have so much to talk about. It's narrowing it down. But this month, I want to jump right in. We want to talk about China. We haven't talked about China in quite a while. Any comments before we talk about China?
Only that I've been writing about China for a decade, based on my visits there and my friends that are there, and a wealth of charts, some of which we're going to share with the audience today.
Yeah, Charles, I have up here the agenda chart, and really I want to net it out if I can. I'm probably going to talk a little bit more than normal here, so you're going to interrupt me as we go here, but just so we go through these charts logically, and that is China is facing two key issues in my mind. And what are those two key issues? And they center a problem that they have and what that central problem is in managing their country. And as you can see on the chart, it's about creating jobs and creating employment is the problem. But people, I want to make sure our listeners really understand the central issues that we have in China, and then maybe most importantly, what the markets are about to do, because we're at a really important time here in the global financial markets and in the United States, and it's all about the FOMC meeting, and China is central to that FOMC meeting decision that's going to be taken. But putting it into perspective, this chart here we have up is that everybody thinks that the United States consumers the engine of the global world. It was for years. It is no longer. Since 2008, China is the global engine. But you've written extensively about the Triffin paradox. It actually is the U.S. consumer, but what's happened is we've created so much debt that it's allowed China to expand and grow at such a rate that it's now at an almost unsustainable run rate. And that run rate is based on exports that it had and imports that it brings into the country, which has powered the rest of the world producing a lot of their exports, but China's imports into the country. I think we all know that, but I don't think everybody understands the degree of which debt has actually financed the expansion in China. Any comments on that, Charles?
Yeah, Gordon, I would just add, as you said, the commodity-based economies have been selling to China. The iron ore, the oil, everything. Those economies have grown wealthy based on selling these raw materials to China. And U.S. corporations have reaped enormous profits by moving production to China. So as China slows down, there's an impact on the U.S. because, all the iGadgets, iPods, iPhones, they're all made in China, and the profits go to Cupertino in Silicon Valley, right? So it's been a boost, not just for those selling commodities to China, but it's been a huge boost for the developed world in terms of reaping huge profits off of their cheap labor force.
Yeah, a lot of this I think everybody's kind of familiar with, but the magnitude of the commodities that's been used, the manufacturing that we've offshored, downsized. We've had 54,000 companies leave America, not companies, manufacturing facilities that have ended up in China. That's been explosive. I have up this chart here that shows how much debt it's taking, in debt per how many billions of dollars per percentage point of GDP growth, and you can see in orange red here that up until 2008 how much it was taking in the United States, and then we had a problem. But now look at how much it's taking in dollar values in China. to get another percentage point of GDP. These are becoming insurmountable. So this run rate is just, how do you sustain it? How do you get that much more capital infusion? How do you create that much more credit? Especially if you may not have the dollars coming in, as we'll talk about, from imports, or from your export trades where you're making money. I have up, so the bottom line is this chart I have up now that says the good news in China is that they produce far more than they consume. In the United States, the bad news is we consume far more than we produce. But now what's happened in China, the good news has become bad news because they're producing, their surplus is so large that the world no longer can absorb it. The world is now slowing down. They're producing, their production is so much higher than the world can now consume. And we're seeing that in trade, shipment, everything's slowing down. But it's like it's a virtuous cycle going up. It's a vicious cycle coming down, because suddenly if it's slowing down, everything slows down, right? So that's what's happened in the world, and part of what sustained China is, and what the driving force or driving problem I said at the beginning is the population is, we know it's huge. And the population growth in China, as you can see from 1980 here in this chart, has been huge. But China's done an unbelievably spectacular job of creating jobs for everybody. And so the employment has actually been there to support the population growth, and especially as people have come from the rural areas into the cities. But that's come to an end. They're no longer creating the jobs anymore. And as I just said, with this surplus, the job growth rate is slowing down. In actual fact, I saw preliminary numbers, it may have actually shrunk last year. And this is the number one thing in the country that the government's held to, is create jobs, create employments.
Right, absolutely, Gordon. And I want to mention here that the general theory out there of conventional financial media is China is going to rebalance itself from a production economy to a consumer economy. And unfortunately, I don't see any evidence that that's possible. And on my first visit to China in 2000, now this is 16 years ago, the news and the financial headlines at that time was they were already making too many TVs for the Chinese economy. They had to shutter some TV factories. So they were already in overproduction to meet China's needs in 2000. And now we see the same overproduction, overcapacity in autos, in virtually everything. And so what most people don't understand is there's about 200 million of the 1.3 million Chinese are middle-class people. They live on the coast, and they already have everything. They all have cars. They all have investment condos. They have every electronic gadget. They've got closets full of clothes. I mean, they've got everything we have. The billion people that live in the West and in rural places, they don't have the income to become middle class and support more consumption. So this rebalancing was what China attempted last year, and it failed. It didn't go anywhere. Their economy started rolling over. So now they've gone back to plan A, which is create another real estate property bubble with all that credit you've talked about. And that's going to end badly too.
Well, you can see the chart I've up here on construction. What China's done is it's spent all of this money that it's received as profits, call it FX currency reserves, and they have $4 trillion of currency reserves. They've got a reserve ratio of approximately 16.5, so it's 5 times. That's $20 trillion it's had pumped into its economy, into its banking system, thereabouts. And that money has been spent in the country, a lot in manufacturing, but that was a different form. That was capital coming in, capital formation. But they spent it on infrastructure, buildings, roads, rail stations, airports, all positives. But the bottom line, they built it out so much and to such extent, you have ghost cities everywhere, right? Ghost malls, shopping centers that are bad at malinvestments. So there's a whole discussion about malinvestments, and you have to sustain the maintenance of these things if they're non-performing. But the bigger point here is, how do you sustain the run rate of all those people that are being employed now if you're not going to continue to build more and more ghost cities and more train stations. And that's the problem. They ran right up against this wall as regards of the amount of profits they were making, and now the rest of the world is slowing down. And we've talked about this. Quantitative easing was put in place in the developed world was to bring demand forward, and it might have done that for a couple of years, and demand hasn't grown. But the bigger problem is what it really did is it created more supply. So cheap money meant around the world $9 trillion in emerging markets, not China, in building out supply and capacity. So we have this massive overcapacity. So that we've got a run rate on that. But the second point of this, the second issue is, and it's just as critical, is all these factories were actually built by capital coming into the country, not profits from your trade, your exports, and but money, capital flowing in. And if you see this chart here, China has a completely different structure than the United States. We're a consumption economy. That's what drives our GDP. It doesn't drive their GDP. It's down in the mid-30s. What drives theirs is capital formation, capital coming into the country. And that's changed, and it's reversed, and it's been falling off. And the chart here shows you that it's actually reversed and been fleeing. Money is exiting China. Ever mind, they need it coming in. So how do you get more capital coming into the country to sustain that part of the growth problem? And I know you were making some observations on Bitcoin.
Right. Obviously, Bitcoin's jumped about $100 in a few weeks and surprised a lot of people. But it's not that surprising if we tie that demand for Bitcoin to Chinese demand for a mechanism to get their money out. And we've seen a lot of crazy schemes like buying domain names for $600,000 and then selling them for $200,000, and then you at least laundered some of your money. So Bitcoin could very well be a benefactor of that. But Gordon, I want to speak real quickly to your fixed capital formation chart here, showing the enormous flood of money that went into China to build all those factories and invest in production. Well, now that production is in overcapacity, it makes no sense to put your money in China to build another factory. In fact, people are leaving China because their labor costs have gone up by, I think it's something like a factor of 6 in the last decade, as China has met the demands of its labor force for more money. Well, then now it's people are leaving China, shuttering their factories there, and moving production to Vietnam or other places. And anecdotally, I have some contacts and friends in manufacturing, piping, and stuff like that, which have already done that. They shuttered their place in China and moved production to Vietnam because it was so much cheaper.
So here's China with this labor problem, massive labor problem. 20 million people leaving the rice paddies every year, going to the urban centers looking for new jobs. Used to be 50 million, and now you've got these kind of issues. But they have to compete on a productivity basis, and even with cheap labor, it's forcing them to automate with robotics, etc. So the manufacturing facilities themselves are forced to become even more productive. And it's not about labor costs. It's just about simply trying to drive that cost down with more efficiency in less amount, producing more in less amount of time. And it isn't just labor. So the robotics is causing another kind of massive problem in China, and they have no choice. They can't just throw labor at this problem. It doesn't, more people doesn't create a baby faster, does it? It still takes 9 months. Is that the old, maybe a bad analogy, bad metaphor, but they just can't do anything about it. So they're trapped. And so what do they do about it? And I got up this chart here that shows, and to take it full circle back to America, they're being forced to sell to keep cash flow going their foreign reserves. And what do they hold those foreign reserves in? They're not sitting in a Chinese bank account. They're bought U.S. Treasuries. The biggest buyer of U.S. Treasuries and holders has been Japan and China's bought them. They're starting to sell them because they actually need the cash flow, if you would, which also, by the way, reduces their reserves, which reduces their deposits in the banking system. So that can't go on very long, or it's going to catch them. So what do they do about it? I personally think they really have no choice. And I'm looking at this chart that says need 6.5 units of new debt to create 1 unit of GDP. I was showing that originally was dollars per, but this is units. If you would, they've got to create more credit to and put it in some way. And so what do they do? That I believe, Charles, their only solution is a devaluation of the yuan. They've got no choice. And that we learned last August when we had a devaluation of the yuan seriously rattled the markets. Is that a possibility that we have a significant yuan devaluation coming despite what the United States has been threatening about that?
Absolutely. And just for context, Gordon, let's recall that about a decade ago, there was a lot of complaints that China was manipulating its currency by keeping it cheap. And so in response, the Chinese yuan increased in value such that it used to be about 9.5 to the dollar, and then it fell all the way to about 6.1. So there was a very significant strengthening of the yuan over the last decade. So now what we're talking about is a reversal of that, where the yuan will probably be forced to go back up to 9 to 1. A huge devaluation from 6 to 1 to 9 to 1. And you're suggesting the first step would be a target of 7.5, which is what, 25%?
Yeah, these are big moves. These are big devaluation potentially, whether it's 1 step, 2 steps, or how they phase it in. So, but it's almost like there's no way out. They have no choice. They need to devalue it so capital is cheaper. So to invest in China, your big dollars going into a cheaper Chinese yuan makes it more attractive. So the capital problem, number two, we said, fixes the problem. It helps with the problem, and also it makes your exports that much cheaper. So there's a chance that it fixes the first problem we have, the trade balance potentially. There's actually no other alternatives they have.
There's a fly in the ointment, and we're seeing it everywhere in real estate markets in hot cities like Toronto, Vancouver, the Bay Area. You have your chart here, China hot money flows. Money is fleeing China because what do you do if you hold yuan? You want to wait until you lose 25% of your purchasing power of that money? Or do you want to get it into another currency or another asset where you're not going to lose 25%? So we're seeing capital flows in the trillions of dollars is the estimate. No one knows. But you talk to people in these hot cities, and I live in the San Francisco Bay Area, so we're somewhat of a beneficiary of this capital flow. But in Toronto, I just was speaking to someone that lives there and said that in parts of the city, the real estate listings must have the number 8 in the price, because of course that's in Chinese that is considered a sign of prosperity, right? So in other words, it's distorting economies around the world, this gigantic money flow out of China. And so it's weakening China, it's hollowing out China's capital markets, but it's also fatally distorting and disrupting markets around the world where the money is flowing. So that creates another problem.
And this, as the chart says, has been going on for a year now and has been accelerating, and as we talk is a massive problem that China has to take right now, has to do something now to stop it. And that's why we've talked about this. The Shanghai Accord was struck at the Shanghai G20 meeting, we believe, and we tracked that quite significantly, to try and alleviate, devalue the yuan on a relative basis. And I have up here a chart that really shows this wedge going down was the actions that were taken by the ECB, by the BOJ, and the FOMC that shocked the market. But it was all part of this Shanghai Accord to increase the yen, to increase the euro, decrease the dollar, weakness in the dollar, and by doing that on a relative basis, it actually devalued the yuan, make it more attractive, because Europe is the biggest trading partner of China, so it was important, and it was working, sort of, but not to the degree to stop this capital flight. It just wasn't enough. It was too slow relative to what the Chinese did in August. So So the Chinese have been saying to the United States, we've got to do something about this. And then, Charles, and this is really, I found shocking, this chart shows you something magically happened right there at the bottom and everything reversed. And that's when Yellen went to see the president, surprise meeting. What they talked about, nobody knows about, we don't know, and called an emergency FOMC meeting. Both of these are extremely rare. And we could get nothing. What happened in that? Total secrecy both ways. So we still to this day don't know what happened at that meeting. But I know this, you can look at this chart. Something changed. And at that point, what happened is the dollar, which had been weakening, started strengthening and started strengthening significantly. And what happened also is we started talking up the rate increases, that we were going to increase the rate, we, the FOMC, and that increased the value of the dollar. The dollar started strengthening, which is bad for the global economy. And you can see on the blue here where the Chinese came in with 4 devaluations, not dramatic ones, trying to weaken the yuan. It wasn't successful. Every time they did it, it still kept on going. But we kept talking up these interest rates that we're going to have. Comment?
Right. Yeah, Gordon, let's go back. Something we've talked about many times, which is critical for the audience to understand, is the peg. The Chinese yuan is pegged to the dollar. So the dollar's risen 20% in the last 18 months or so. That has dragged the yuan 20% higher as also. That's been a knife in the heart of the Chinese economy to have their currency strengthened by 20%, right? So that's the driver of why they need to devalue at least 20% just to get rid of that, the consequence of the stronger dollar. And so, but if you devalue enough, then you cause currency flight because everybody with cash in China tries to get their money out of yuan because they don't want to see their money lose 20 to 25% of its purchasing power. So then this ties back to the interest rate, which, as you point out, even though it's near zero, in a negative interest rate world, the U.S. Treasury still looks pretty good. You can get 2.6%.
It's the most attractive paper in the world. I mean, it's on the positive side of the curve.
Yeah.
So the money's rushing in. Right. To at least hold it as a safeguard in U.S. Treasury. So in spite of these countries selling, like China, like Japan, the OPEC countries selling our treasuries, there's other money just up. The auctions are being sold out because of this positive yield, but which is also pushing up the dollar again. It's making the dollar much stronger. And you're saying about China, the problems in China with the stronger dollars. What I don't think most Americans really realize is a stronger dollar means everybody else in the world, things become more expensive. Because most countries trade in U.S. dollars. So if they're buying something, it suddenly went up in price against their currencies. You want to put a drag on the global economy, on the global world, all of a sudden everything's got more expensive. So it compounds China's problem even more, right? It's because of the other countries' trade balances themselves. So it's a difficult problem, a catch-22.
Exactly, Gordon. You've described the dilemma that the world has. If the Treasury continues to earn 2.6% in a zero-rate economy, money's going to keep the tailwind is behind the dollar, pushing the dollar higher. You can't fight that. If it's my job to earn some kind of safe yield on $10 billion, am I gonna buy a bond that pays a negative 0.01%, or would I rather get 2.5%? I'll take the 2.5%. But then the negative consequences you just described from a stronger dollar, you can't fight those either. There's no way to mitigate that, as the Chinese are learning.
We've got this chart I show you. I got a box over here on the right hand side, and that is on Monday, June the 6th. We have a strategic meeting between the United States and China. How timely. And this is an annual strategic dialogue, it's called. And it's a 2-day session. And China has been very, very clear. They expect the United States to spell out what its FOMC policy is going to be. And Treasury Secretary Liu said, we won't do that. We're not prepared to tell you what we're going to do. So there is a real fight coming because everything that China needs to happen is centered around the U.S. dollar. And anything the FOMC does in terms of a statement will impact the U.S. dollar. So it's not about interest rates, it's about the impact on interest rates. And I have up a chart here that Deutsche Bank put together, and we've been working on a similar kind of concept, and we're caught in a loop. So and I'm showing you where I think we are in this loop, because every time that we get to a point where we're going to do something, it takes down a strengthening yuan, for our devaluation of the yuan kills the markets. And so when the markets start to sell off, we have a collateral problem in the United States. We can afford the markets to be weak. We can't afford a serious drawdown on the markets. So the Fed is forced to, it wants to increase rates, but too strong a rate or any kind of move hurts the markets. But now it's complicated. Here, if you go through this chart, it's complicated with the value of the yuan. And there's a direct correlation with the markets going down and the exchange rate on that yuan, because it's the global engine. It's the dominant force. It used to be the U.S. economy and the U.S. dollar. So the point I'm trying to get to here is this meeting that's coming up, and the fallout on the FOMC meeting in June, when we expect this rate increase of a quarter point, is incredibly important. And as you said, on that U.S. Treasury, on the yield curve, depending how it reacts, 0.25 when it's on a positive is now a big deal. It doesn't sound like it, but it's noise, but it's globally a big deal if you're looking for a flight to safety.
Right.
They're caught. This meeting is the FOMC. Yellen is in an impossible situation, and then they also have Brexit. They can't possibly increase this rate before the UK makes a decision on whether it exits the EU, which is right now a very close decision. So what do you think they're going to do?
Gordon, and I think your charts show us that the dilemma, both for the Fed and the Chinese authorities, is unsolvable. No matter what you do, there's going to be a negative consequence.
Exact. My feeling, I'll speculate, Charles, I think they may delay the FOMC rate increase, and I was expecting weak labor numbers, and sure enough, we got them. So to give a little bit of cover, buy a little bit of time, maybe that'll happen in July with the rate increase to allow China itself to do some adjustments. They've got to come up with a strategy in here. But my opinion is the yuan will be devalued, and it will be brought down. And if it does, the markets will go down. That would be the catalyst. And maybe the United States came out 4 weeks ago and accused Japan of being a currency manipulator, and of course China. And maybe we're looking for a market sells off because China devalued. They were the bad guys. We can't increase rates. We have to weaken the rates. Especially in an election year. So all of a sudden, we're riding to the rescue for the global economy, if you would, by reducing rates or not increasing rates and blaming it on China devaluing and the yen also having to be brought down. I may be speculating too much, but I think we're looking for cover because Yellen knows she can't increase these rates for a lot of other reasons.
Right.
Because the U.S. and the other reason, the U.S. itself is facing a recession.
And I think we should mention here that as China devalues, it only increases the pressure on capital flows out of China. So they may be forced to pursue some sort of really strict capital controls. And then the other
surprised they haven't implemented stronger capital controls already.
Right, me too. The other thing you mentioned is all these pressures on against job creation in China. So if the labor unemployment rate rises there's the potential that we've discussed in the past for social disorder. And you see it sometimes on the news already, where factory workers haven't been paid. The factory closed and they've got back wages that weren't paid, and so their only option is taking.
I didn't mean to make this a discussion of speculation, Charles, but I think that all our listeners should be able to see there's the catch-22 that's here and the problems that are centric. But if there was a message I'd like to leave is it's not just about they devalue the yuan and trying to get the economy, because I don't see any growth. It's not in the U.S. consumer. It's not because they can sustain the production. There's no growth engine in the world that's going to sustain it at the current run rate. So there's a problem coming. But the bigger issue is social unrest. We're already seeing it in the United States because there aren't jobs. I think we're seeing it in the primaries and the frustrations. Maybe we're not articulating it as well. But if China they can't deliver jobs and they have layoffs, that is incredibly destabilizing to China, will be to China. And I think we're seeing it around the world. We can't create jobs, or at least jobs that'll support an income, because inflation is eating away every day at disposable income.
Right.
I don't mean to be a doom and gloomer here, but we're out of runway.
Right. This and to go back to one of your previous slides, I think it's important to remember there's no global sponge now for China's overproduction, and so that means it's a problem. And as you point out in the slides, there's a capital flow problem. China needs to create an enormous amount of debt just to keep their economy from declining, from contracting. And that creates its own set of problems. You can't just keep creating trillions and trillions of dollars of new credit to keep things running in place without there being
This is a consequence of quantitative easing and ZIRP, where it created excess capacity, not excess demand, excess capacity. And it's like everything. It's a great party until all of a sudden you reach a point where the demand doesn't match the supply, because the party was going on because we could create so much supply, and now we've reached that point, and it's right here in China. China just can't. It'd be different if they could consume more, but as you point out, their consumer is not balanced the way it is around the world. Charles, any closing comments you'd like to make here to recap?
No, just that I think your slides are give an excellent précis of the dilemmas that face both the developed world, and the Fed and the U.S. economy, and also China. It's all interlinked. You can't disrupt one part of it and not have blowback and consequences in the other part of the global economy. So what happens in China matters deeply to
The point I'd make in
else.
closing: don't ever underestimate what the central bankers and the governments will do with changes of policies to try and get out from under these kind of problems. And whether it's buying the stock market, as they're doing in Japan, the Nikkei, the biggest buyer of ETFs is the Japanese government, to keep up the collateral prices or whatever. But we're going to be shocked at monetary policies. And I'm not talking about just helicopter money and these kinds of things. And there's a lot of discussion, a lot of dialogue going on behind closed doors, that what we may start to see is a global stimulus plan, fiscal stimulus plan, coordinated in countries of building out infrastructure. And that would become the auspices. I know Summers, former Treasury secretaries around the world, pounding the table on this, that would give the cover for all these central banks to increase their balance sheets dramatically. That is, it's actually the treasuries that will start to governments buying, therefore increasing the balance sheets of the banks, to be a stimulus. Because right now we're out of monetary policy solutions. We need fiscal stimulus, which is deficit. Or at least that's the perception. And this could be big and absolutely massive. But it would take something like that to restart this demand to balance the supply. And whether they pull it off or not, but don't underestimate and expect the unexpected. Expect something like this to come out. And in the United States, we have Trump, the big builder. We could be doing a lot more building than we think right now. Anyway, we have to wrap. Any comments?
Keep an eye on the global imbalances that we've described, and that they're not going to go away, and that doing more of what has failed spectacularly will fail spectacularly again.
Next meeting, we will have been through the FOMC. We've been through Brexit. China's probably given us some signals, so we'll know how close we were on speculating this month. Talk to you next month, Charles.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.